Hello, everybody. My name is True Demon, and I am the Devil Stockbroker. In this video, I'm going to be covering a quick tutorial on how to use our ScourgeBot in Hell's Trading Floor for analyzing gamma ramps on various stock tickers. So first, I want to explain what a gamma squeeze is. When you have a situation with a particular stock that is traded with an options market, specifically this occurs with call contracts or call options. When you have a large amount of open interest, that is the number of contracts that are currently open on the market for a particular stock. This is typically used as a gauge for how many individuals are purchasing a certain contract or holding a certain contract. What can happen sometimes in the market is you have a series of strikes with extremely high open interest that are close together. So you might have strikes $1, $2, $3, $4, $5, and a stock is trading at say 50 cents, right? If there's enough interest in those call options where you have 10,000 open contracts at $1, 10,000 contracts at $2, and another 10,000 at each strike above that, all the way up to $5. And the stock ticker only has, we'll say, 5 million shares in its float. Now, those 50,000 options contracts, because calls are a contract which gives the buyer the right but not the obligation to purchase 100 shares at that strike price. So one call contract at $1 gives you the right to purchase 100 shares at $1 for every contract that you hold. So 10,000 contracts, you multiply this number by 100, you get 1 million. So for every 10,000 open interest, you get 1 million shares. So trying to visualize this with a chart, I'll just go ahead and use Bed Bath & Beyond's chart for this as an example. So Bed Bath & Beyond is trading at currently $1.60, okay? Now, Bed Bath & Beyond has strikes at every 50-cent level. And there's a lot of open interest at each of these levels. So at $1.50, there is a significant number of call contracts. At $2, there's a significant number. At $2.50, there is another. So the purpose of taking note of these is that for every strike, there is basically support below the price and resistance above the price. So you can think of these as a form of resistance or support, depending on where the price is. The idea of marking these is because think of who is motivated by the different trades. So if you have a market maker who likes to sell call options, which they do, they use this as a way of getting income. They sell options into the market in order to provide the market with liquidity. They're motivated to make sure that those options expire worthless, hence they don't want the price to go above these levels. The more call contracts that expire in the money, the more shares they have to deliver to the people that they sold those calls to. So when you see the price moving up to these various levels, you'll notice that it kind of like struggles and it will sort of like get pushed away, or it'll get pinned to that price where it's just about that price, or maybe just 1 cent below it. The reason why this happens is because market makers have something what is called delta risk, which is a concept that relates to options Greeks. Delta risk, symbolized by the symbol delta, is it refers to the intrinsic value of those call contracts, and this is directly related to the share price. What this means is when you have the price of the underlying stock, say Bed Bath & Beyond goes to $2.10, then all of these call contracts at $2 and below are called in the money, which means that they can be exercised. Somebody can exercise their right to buy those shares at the strike price for their contract. On the other side of that trade, you have the market maker who is obligated to provide those shares. Now, the way that most market makers make their money is basically by selling naked calls. This is not to be confused with naked shorting. Naked calls just simply means that you're selling a call without owning the shares to deliver. And while this is perfectly legal, it is extremely risky because you are taking the risk that that share price will never get above that strike. Because if it does, then you're going to have to buy those shares at whatever the market price is. So if it's trading at like 210 or 220, you're going to have to buy those shares if somebody exercises their right to purchase those shares for $2. So you take a big loss. So if the difference between the stock price, say the stock price is at $2.20, and you sold a call for a $2 strike and somebody exercises that call, then they buy those shares off of you for $2, but you have to buy them at the market price, which is $2.20. So you take a 20-cent loss for each share. That amounts to 20. That's a $200 loss. Or no, that's a $20 loss. Excuse me. My head math is all screwed up. So I was right the first time. You take a $20 loss on that contract. And what happens if you have like tens of thousands of these contracts all expiring at the same time? You can get into a situation where a gamma squeeze can occur. Like I mentioned earlier, there is a whole bunch of call contracts that are just sitting out in the market at $2 and $250 and $3. Like every single one of these levels has an extremely high amount of open interest on it. So this is something that market makers have to account for, because if they do not account for it and the price starts getting away from them, meaning it goes up and puts all those contracts into the money, then the market maker might not actually hold on to enough shares to cover that obligation. And this is where a gamma squeeze can occur, especially if there are strikes with very high open interest that are very close together. And this is what forces market makers to do something that's called delta hedging. Delta hedging is a way of hedging delta risk, meaning the risk against the price moving up in value. So when the price starts to get very close, what a market maker will do is they will take an account of how many call contracts they have that are that they have sold in the market for this particular strike price. So as the price approaches $2, what the market maker will do is they'll start buying shares at market price below the strike price. And the reason why they do this is so that they make a profit off of the call contract and they're able to deliver those shares rather than getting into a situation where they are forced to purchase shares at market price above the strike price. So they want to get it cheaper than the strike price because then they'll make a profit. But if they wait too long and the price goes too high and they don't have enough shares, they'll take a loss. So delta risk and delta hedging to manage that risk is how market makers ensure that they never lose in the options market. So what this means is that as the price approaches that strike, the market maker is going to have to start accumulating shares if they don't have enough to cover their obligations. And when you have a gamma squeeze situation or you have a lot of strike prices with high open interest close together, the market maker can start hedging here, and this actually requires them to buy shares. So this can cause the price to lift. And if it happens fast enough, then it can send the stock price high enough to trigger the market maker to start delta hedging the next set of options. When you have this in quick succession at various price levels, going from all the way from like say 100 or $1.50 like Bed Bath and Beyond is at right now, and it has a high amount of short interest at every single round number value after that point, it can start causing a runaway effect where the market maker is forced to hedge all of those strikes because their buying activity, their delta hedging activity, actually causes the price to move up fast enough that it forces their hedging algorithm to start working on the next set of options. Now I get to tell you how this relates to ScourgeBot and how we leverage this ourselves. So I'm hanging out here in the trading floor. Everybody go ahead and wave at the camera. And all the members of Hell's Trading Floor who are hanging out here, we're going to actually do a quick analysis with our ScourgeBot. So there's a particular command that we use for analyzing gamma ramp charts. And that command is inspect underscore short squeeze. This command has a few other features that are built into it and some other data that it uses. But we're just going to focus on the gamma ramp component. Okay, so we're going to focus on just this chart right here. The information that it gives us here is relevant, specifically the float, because this is the number that this chart is using to calculate the percentage of float that goes in the money. So we'll just keep the float number for right now. This is the only one that you need to keep in mind for the purpose of this chart analysis. The second component that this command gives you is it will actually show you the open interest for total calls, total puts, in the money and out of the money calls, and in the money and out of the money puts. And this chart itself is the quote gamma ramp. So this is how a gamma ramp chart works. As I mentioned before, there is what we're looking for is we're looking for a high concentration of open interest in call contracts that is in quick succession of strike price. So when you look at this chart, what you're looking is basically as the price of the underlying stock increases, it's moving along this x-axis, which is the strike prices. So this chart is showing you the distance between the stock price. The y-axis is showing you the percentage of the float that is in the money. Why do we focus on this number? The reason why we focus on the float that is in the money is because this is directly related to supply and demand. When we talk about gamma squeezes and big gamma ramps, the float is very important because it directly affects the ability of market makers and institutions to pull shares out of the market in order to fulfill their obligations to these call contracts. In some situations, such as what with BBIG is doing right now, there are actually enough contracts in the market that it significantly outweighs the amount of shares that are available for purchase. What I mean by that is there are so many call contracts on the options chain right now that if all of these were to go in the money, say that Bed Bath and Beyond were to go to $10, it would actually make it so that 150% of the float, that's 1.5 times the float, would have to be purchased to fulfill all of the obligations of market makers to deliver those call contracts, which is mathematically impossible. What this is telling us is that if the price were to increase to this level, there would be a massive panic on the part of the market makers and anybody else who sold call contracts that didn't have enough shares to fulfill their obligations. And the reason why is because there's not enough shares in the market to do it. They can't mathematically deliver all of these call contracts. So what would happen if the price went from $1.50 to, let's just even say, $3? That puts 50% of the float in the money. And this will cause a cascading domino effect of delta hedging activity that causes the price to rise even further up to $5, which would put somewhere between 75 and 85% of the float in the money. And the further up you go in this chart, the more ridiculous it gets. A movement from $1.50 up to $10 is a huge move. Don't get me wrong, but the amount of calls that are available on the options chain make it mathematically impossible for them to get those shares. Hence, in order to meet their obligations, if all of these go in the money, they're going to be forced to buy at such a rapid pace, and all of these different institutions will be forced to fight over the price, which is going to cause volatility and massive price action. In this case, market makers really only have two options. They can either buy to close their call contracts, which if the price keeps going up the way it is, that can cause massive volatility and an increase of IV in the options contracts, as well as causing the stock price to rise as that IV increases because the share price is often directly correlated with volatility in the options market for any particular stock. When interest in options, especially call options, rapidly increase in any stock, that is typically a signal that algorithms use to signal a purchase order or a buy order on that stock. So this is the use. This is the utility of this particular command. Again, the command is available to the daemon members of Hell's Trading Floor, and that command is inspect short squeeze, and then you feed it whatever ticker symbol you want to analyze. So you could do this on literally any ticker. You can do it on AMC, Troika, or TRKA, and you can see other gamma ramp charts just like this. If a stock ticker doesn't trade options, you won't get anything out of this, just to let you know. But in the case of AMC, you can see AMC also has a gamma ramp chart where approximately 25% of the float would be in the money if it just rose to $10, which is a massive amount. To illustrate the effect of this, I want to make mention that it's very rare for any stock to have a gamma ramp as large as Bed Bath and Beyond does. There's only one other time in the history that I've been doing this that I've seen a gamma ramp chart this large, and that was actually SPRT back in August of 2021. That was a stock for support.com, which was it was a .com era company that got started back in the late 90s, and they got smashed in the .com bubble. And they were trading in 2021 at around $5. By the time, for some reason, there was a bunch of interest in it, and there was a suspected merger that was going on, a big acquisition between them and another company that was causing some interest in the stock, and it created a big gamma ramp on this. At the time, the stock had something like it was a really small float stock, but there was enough call contracts that more than 100% of the float was available for purchase or was on the call chain at, I think it was a $10 strike, and the stock had already been trading at $8. So when all of those call contracts went in the money and SPRT went above $10, a week later, it created such a massive supply and demand imbalance and a panic for market makers and anybody who was short call options that it caused the price to skyrocket from $10 to $58 in 1 week. It was the most insane gamma ramp I had ever seen. So this is a historical chart of SPRT back in 2021 when this trade was occurring. Before the merger and acquisition announcement, the stock was trading at less than $2. After that announcement came, it had a huge pop and hit $10 before coming crashing back down. But from that point forward, it was in a big incline, and it was slowly making its way back up to $10. What this huge pop in volatility created was an opportunity for those call contracts to be created, and a whole bunch of market makers opened up calls. They basically wrote calls at that level and set them out for huge dates, like very distant dates. They were basically writing leap options, promising that they would be able to deliver 100 shares per contract as far forward as like January of 2022. Well, what ended up happening was there was so much hype that built up in it as that gamma ramp was created at $10, and it only continued increasing from there. So it was actually more than 100% of the float was on the call chain by the time it got to $10. But once it hit $10, it triggered this massive delta hedging event where market makers were forced to purchase shares and compete for price in order to make sure they were capable of delivering on their obligations. It caused the price to rise so fast that in just 1 week, it went all the way to, as I said, $59 at the high. You can see it right there in the corner on August the 27th. The high of the day was $59.69. That was the high watermark for SPRT. The highest closing price of any day was $36. So this is the kind of insane volatility that can happen with these kinds of plays, and this is why I love the ScourgeBot short squeeze chart. It's got to be one of my favorite charts to use on the regular. I make this a part of my standard analysis practice anytime I'm looking at any kind of stock which is trading options of any kind. I always make sure to check it for a gamma ramp whenever I'm deciding whether or not to invest in a potential short squeeze stock. So I hope you found this tutorial helpful. If you guys want to check this out for yourself, then please consider joining Hell's Trading Floor. You can join us at our Discord at discord.gg/Hell's Trading Floor by signing up through our website at hellstradingfloor.com. And if you choose to join us with Tier 3 support, you will get direct access to our ScourgeBot where you can make these and many more queries at will whenever you like. Thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.